founded ARK 2014, did the research, and in fact, when we first broke out the 5 major innovation platforms, we did not have AI and blockchain there. We had instead what we called, we had that in mind, those in mind, but we had next generation internet. And as we started doing our Bitcoin research, I brought in Art Laffer, who's a very well-known economist, known for fiscal policy theory as well as monetary policy theory. And he agreed to collaborate. And when he said, this is what I've been looking for. Ever since we went off the gold exchange standard in 1971, a rules-based global monetary system. And I said, oh, wow, how big could this be? And it was only a $6 billion, we called it network value at the time, market cap. He said, well, how big is the US monetary base? And I said, well, it's 4.5 trillion. And now, of course, it's 8 trillion, 7.5, 8 trillion. He said, well, there you go. We have our base case is roughly 650,000 for 2027. Now that has come down. We were using 1 million plus 4 or 5 years out, but because we've had the debacles associated with centralized, opaque institutions, as opposed to decentralized and transparent, institutions are going to hold back a little bit. But we still think that the million plus is right in our bull case. And you can see how we build our case and look at the assumptions, how much institutional involvement and so forth. Very conservative assumptions. And our conviction actually has grown through this year. GBTC was just coming of age, and we were doing our due diligence. And so I bought $100,000 worth, just personally, and Chris became, like, here I am, the portfolio manager, and it was his research that moved me to do this, and like it was so early, and so he doubled down on his research. And it was
it's bad if your boss loses money because of your research, right?
But then of course, you know, the rest is history. I guess we're at, is it 300 billion-ish
like that, yeah.
now, and many people know that we think that's 300 billion in market cap or network value at $24,000. And we have in big ideas, again, our forecast for 2027, I think, is around 650,000, and beyond that, 1.5 million.
Say that again. In the big ideas research that you guys published, what are the 2 numbers?
The 2 numbers are, we have our base case is roughly 650,000 for 2027. Now that has come down. We were using 1 million plus 4 or 5 years out, but because we've had the debacles associated with centralized, opaque institutions, as opposed to decentralized and transparent, institutions are going to hold back a little bit. But we still think that the million plus is right in our bull case. And you can see how we build our case and look at the assumptions, how much institutional involvement and so forth. Very conservative assumptions. And our conviction actually has grown through this year, grown through this past year, because FTX, Celsius, 3AC, Voyager, all of these were centralized, opaque institutions. They went bust. And even the centralized, regulated institutions, now we're looking at Genesis, probably bankruptcy, yes, Silvergate, these are regulated. And they're but again, they're much more centralized. Right, well, Bitcoin came out of 08-09, right? And look at all the regulated companies that went under then, and all of the counterparty risk that nobody understood, you know, and all of the paperwork that had not been done. So, you know, I do think about what you're saying. I think I don't think, we worry about the innovation that is leaving the US and moving to other countries who are much more friendly. The UK, I think, and Europe generally, from a regulatory point of view, has much more of a solution, more clarity than the US. But I think the American DNA is such, and we see it in how regulators are going this far, but and the most interesting one to me, now consider the source, we own it. I want to be very clear.
Everything that we've spoken about today, you should assume one of the two of us own it.
Right. So Coinbase. Now, I'm listening to the regulators, and they're saying, well, if it looks like a security, and it walks like a security, and it quacks like a security, then it's a security. And we will enforce the securities laws. That's what the SEC does. And I'm thinking, well, Coinbase had to go through the SEC. They had to issue an S1, highly regulated. They had a lot of tokens that now the SEC is questioning as securities. Well, has the definition of its security changed since Coinbase went public in 2001? And it went public around the time that Gary Gensler came in. So maybe that's where the disconnect is. Gary Gensler is much more of an enforcer. I don't know, but the definition of a security should not have changed. And if they didn't think these should have been on Coinbase's platform, then they shouldn't have let them go through. I think what it is a process of iterating to the right answer, and it's very messy. So if you look at how derivatives evolved in the markets, it was very messy. They had to put in place not a completely new regulatory structure, but they had to bring the CFTC into the discussion, and we got a whole bunch of new guidelines and rules, right? So I think that's where we're going with this new asset class, which we really do. We believe it's a new asset class. I know that, but I know there are securities associated with the new asset class. So let's just be clear. Bitcoin, you've told us, is not a security. Great. Coinbase clearly is a security, and it has on top of it assets that could be a new asset class. So I think we're iterating. It's been very messy. Even this a concept of staking. I don't know if you saw Gary Gensler's video where he said, no, I'm not talking about stake, S-T-E-A-K. He's trying to make this very, he's trying to be approachable, and I'm talking about S-T-A-K-E. And then you look at okay, the one that Paxos basically said it would stop staking.
There's a couple of them.
Yeah,
I think Kraken said it, and Paxos as well. Yeah.
Kraken. Coinbase has a staking service, but it is a utility, not a security. So again, we're iterating, and it is interesting to watch the SEC try to figure this out. You're right, that is a service. It's a technology here. It's a security here. And it's like, it's complicated, right? So it's interesting. And this really I learned through the internet. The earliest users were the porn industry and gaming, and they became avid users very quickly, right? And that is what makes innovation difficult in terms of investing, because here I was a portfolio manager at the time, and I was attracted to this technology called this is the early 90s, the internet. And there were all these articles out there about what a bed of criminal activity it was. So here's a fairly young portfolio manager. I'm trying to make my way in, contribute to the team, and I'm coming in with this idea that has porn and betting. And thank God, Sig Sigalis, and God bless him, I just went to his memorial service this past week. He gave me the biggest breaks of my career. He believed in me. He kind of knew that what I was saying was right, that, you know, often the earliest adopters are in these two areas, and actually you should look at what they are using and in terms of technology and how they're using it to actually learn some lessons about where the world's going to go. The other thing they do is they grease the skids in terms of, you know, making or helping technology, helping those evolving the technology perfect it, right? So we you know, Wright's law is centered on unit growth. So Moore's law is centered on time, so every 18 months to 2 years. Wright's law is centered on units. So the more something is used, the faster the cost will come down, right? And so those early users are critical to jump-starting technology. So I actually look at what technologies they're using, just to see if I'm, you know, what else is coming down the pipe. You know, the criticism out there, you know, we don't have a not invented here. There is, sometimes people pick up on something that we have missed. That's why we're publishing our models more and more. I find that to be a very effective battle test of our assumptions and so forth. But in terms of keeping our focus on innovation, which is, again, because of the innovation platforms evolving, we have, just to give you, here's what keeps me focused. If you look today at how the market values truly disruptive innovation in the marketplace, both private and public, it's about $13 trillion. So a little more than 10% of the total equity market cap. We think that's going to 200 trillion, more than 200 trillion by 2030. This is in big ideas. You can see the building blocks. That's a 40% compound annual rate of return. Now, if our technologies are doing that, hopefully we're doing something better, picking the right companies and so forth, and we will do better. I cannot say that we will deliver that. Compliance will not let us, or north of that. But as our research, as we see the research breakthroughs happening at a faster and faster rate, and we don't see the traditional world focusing on these, we just know the opportunity is that much bigger. So I learned very early on in my career, it was economics, it was the early 80s, and inflation and interest rates were in the mid-teens. And I came in again, young and Art Laffer trained. I felt like I knew how the world worked, and said, inflation and interest rates are coming down for this, that, and the other reason. That was such a controversial call. You had the great powers on Wall Street at the time, and Milton Friedman. You had Henry Kaufman and Al Wojtlauer, who were the doctors of death and doom. That's just how bad things were in terms of inflation and interest rates. And you had Milton Friedman basically saying, get used to it, inflation is embedded in the system at a double-digit rate. And so the whole world was moving in that direction. And here we were, this little voice, and I mean really little, who was going to pay attention to me? And we were writing, again, there were no computers at the time. So I wrote a 20-page quarterly letter to our clients, mostly pension funds. And it became, as inflation and interest rates were coming down, people wanted to know why this was happening. So there's no, 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 no. Then there's evidence that it is. And then people look and say, why is this happening? And so it's the same with innovation. No, 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 no. The old way of the world is the right way. No, 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 no. And yet the evidence is moving incontrovertibly in the other direction. It's the evidence that keeps us sane and actually is a great shield against all of the criticism. And and one of the reasons we put our research out there and our models out there is we're saying, hey, there is so much happening right now that is going to be highly disruptive to not only investors, but your personal lives. And it is really important that you get on the right side of change. And it's one reason we moved to St. Pete. We'd like to use St. Pete as a place to showcase over time, sort of like Disney's old carousel of progress, which hasn't changed since the 60s. We'd like to show people how their lives are going to change, and our research is the first way of doing it.